The program, excuse me, is entitled SaveHomeAZ. When it first rolled out, it was entitled Save My Home AZ. You may have heard about that. The slight name change came about primarily because there is a program or a website address in place that was Save My Home AZ, or was very similar. And for trademark issues, we had to make a revision. But that was okay, because when we began to consider the revision we were going to make, we considered the title or the name of the program a little more deeply than we had to begin with. And I'll touch on the difference. The Save Our is inclusive, as to Save Mine is very individualistic, and Home AZ is where we all live. And while the program is designed to provide direct assistance to some, it provides indirect assistance to all. It's difficult for people to see that when they're not the one receiving that, but one of my goals is to help them understand that so that they can support the program in general, even if they don't benefit from the program specifically. Does that make sense? If you would advance the slide, Kevin. This is what I refer to as the foreclosure prevention progression. And you notice I did say I. So this is my little design, not proprietary or unique to me, but just a way that I felt I could illustrate to people what occurs in the foreclosure process and how it could actually be prevented. Two things that are essential to avoiding any foreclosure, and I believe firmly that all foreclosures can be prevented. I like to emphasize preventing a foreclosure does not mean that the individuals get to retain ownership of the home. That's very important, because it's two different objectives. Most of us want to remain in our homes, and yet at the same time, we should want to prevent the foreclosure, and we need to understand that they can be mutually exclusive. Okay? But the first step here, when you look at the very top of the circle, it's secure the past due amount and resume regular payments. Well, it's pretty simple. If you fall behind on a mortgage, the lender or servicer is asking for the past due payments, or what they call the payments in arrears. And if you have the ability to pay those payments which are in arrears and resume your regular scheduled payments, then you can avert a foreclosure. And some people can actually do that by liquidating 401k money, selling assets, borrowing money from a family member or friend. And it's easy sometimes to lose sight of the fact that that's a possibility. Now, that's not the highest possibility, though it is the first step in the progression of preventing the foreclosure in our market, because of economic conditions as well, which means a number of households have lost income. And so they just don't earn as much as they've used to, and they're not only falling behind, but they can no longer afford to make the regular contracted payment. Okay, and so that moves us to the second step on the progression, and that's to restructure and resume regular payments. And the restructure is what you probably have heard referred to commonly as a mortgage modification. It's not a new thing, it's just a newly widely talked about thing given the magnitude of the crisis, but lenders have been modifying loan contracts for years since they've been writing them. Sometimes they will defer a payment or two if you're one or two behind and place it at the end of the contract. That would be a modification. And then you resume regular payments. Sometimes they'll agree to taking those 2 or 3 payments and dividing them over a 12-month period of time, adding that excess to your regular scheduled payment, which would cause you to make a little more for a 12-month period of time, but it gets you back on track. And so that can happen. Another thing that can occur under this restructure and resume regular payments is you can do a refinance. Now, the secondary challenge that we have in our market, in addition to the economic situation, reducing incomes in the households, is we have the property devaluation. And so that makes it really tough for anybody to refinance their mortgage, because statistically speaking, about half of us owe more than the properties are worth. And that presents another dilemma. So refinance for many, even if they have sufficient income, isn't an option because they don't have sufficient equity. And so we understand that, but I just want you to keep in mind that a restructure of some type and the resuming of some regular scheduled payment is a way to avert a foreclosure. So moving on from there, you then come down to the traditional sale. Keeping in mind, the objective is to avoid foreclosure. And so a person could sell their home, and we've seen people come to us for assistance who actually have equity in their homes. And it's tough to say, sell your house is worth, $200,000 and you only owe 150, and so you'll make, $40,000 or $50,000 profit, and now you got to live on that or try and figure out how far that'll get you until your circumstance change. But it is an option. And I actually spoke to a lady who allowed her home to go into foreclosure, and she had about $100,000 of equity. And it was her good fortune that the servicer didn't properly document the paperwork, so the bank had them reverse it. And it's amazing when you see that happen, but they did actually reverse the foreclosure, put her back in the title, and then they restarted the process, and she was still dragging her feet and trying to figure out what she was going to do. And I was saying, listen, when they foreclose on this thing, again, you can bet it's going to be right, and you're going to lose an awful lot of equity if you don't either figure out how you can sell or how you can restructure your financing. She'd even regained income, made $100,000, but her dilemma was she didn't have sufficient income to get current and resume regular payments. While she did have equity, she had impaired credit, and she didn't want to take what is commonly referred to as a hard money loan in order to be able to get new financing. But understanding the progression, once you realize you can't do step number one, then you consider step number two. If that's not an option, step number three is the next step in the process. Now, because we've had this depressed property values, most, or at least half, don't have equity in their home, and that's where you hear this new phrase, short sale, come into play. And the only difference between a short sale and a traditional sale is you need the lender's consent to sell. And the reason you need the lender's consent to sell is because they're not going to receive all that you owe them. And therefore, they have to be in agreement with you. And that has been an arduous task in our marketplace. Short sales have taken anywhere from, maybe 3 months to 13 months, and some even longer. And a part of the problem is because lenders aren't as willing to express to a consumer how much they're willing to take for a property in advance, because they feel as if they do, you're just going to, drop right down to that and try and sell it. On one hand, it seems like, okay, that's a reasonable explanation for not being willing to reveal that information. But on the other hand, when they don't tell you in advance how much they're willing to accept, you can get 1, 2, 3, 4, 5 contracts, and it takes them so long to evaluate those contracts. You lose 1, 2, 3, 4 offers on those properties. And I've seen sales literally go from $200,000 to begin with on a house that is old $300 down to about $150 by the time they figure out how to accept a contract. And that's depressing, but true. And so lenders understand it. It actually costs them real dollars. When I'm explaining this to people, I try to remind them, because I've been in lending for a long time, and it's easy to forget that this is real money we're talking about. And when that sales goes from 200 to 150, it's a true loss of $50,000 of real money that somebody lent. And so they need to, and they understand, figure out a better solution to that. And you may have heard about HAFA, which is the Housing Alternative Foreclosure Option, or Housing Affordable Foreclosure Alternative. Short sale process under Making Home Affordable, and I'll share with you a little bit about that. But the main thing that process calls for is for the lender to tell you in advance how much they're willing to accept for the property, so that you can more effectively market the property and then get a number that they have to accept, as long as it's not less than what they've already said that they would accept. So, that's a major step forward in terms of that process. It still, again, doesn't keep the homeowner in the home, but I've talked to a number of people who've done traditional sales or short sales, and you'll hear this and probably be able to appreciate it, that once you get out from under, you start to breathe better and sleep better and see more clearly. And it's really difficult for people who are focused on maintaining their home, but maybe not as capable of maintaining their home, to see what's truly in their best interest. But once you get to this point of understanding that you're either completely out from under it, or you have a clearer view of what's going on, things really do start to fall in place, because you can commit to what you see you're capable of doing, and now you can go about doing it. But the last one is the deed in lieu. And the deed in lieu is just what it says. You give the lender the deed in lieu of them foreclosing. And most lenders really don't want a deed in lieu. They'll take it. But the problem with that, just so you understand, is if it doesn't go through the foreclosure process, which is what we're trying to prevent, and it doesn't go through the traditional sale or the short sale, you still have to have what they refer to as a clearing of the title. And so if you have a first mortgage and a second mortgage, when you give a deed in lieu to the first mortgage lender, they still have to work out the clearing of the title with the second mortgage lender. In the foreclosure process, that takes place. In the sale process, that takes place. If you have judgments or other liens on the title, they still have to work that out. So it adds some complexity to their getting a clear title, which is absolutely what they need in order to be able to sell the property again. And so many of them would like to avoid the deed in lieu, though it is still a better option than the foreclosure because it doesn't come with some of the added expense. It just comes with some added steps that they have to go through in order to get the clear title. Make sense? Good. I'm going to check with you sometimes, and I appreciate you nodding your head. And the only reason I say that is because I know we are very accustomed to listening and not receiving, and nobody confirms that you got what they gave, and I really want you to get it. Okay? Good. With that, we'll go to the program, and I'll talk to you about the structure of the SaveHomeAZ program. This is a screenshot of the Arizona Department of Housing's department website, and it can be located at azhousing.gov, and that's on the cards that I handed out to you as well. So if you go to that website, you'll see this landing page. There's some explanation about the program here, and I do encourage you to read it. While I'm going to tell you about it, if you'll read it, it will reinforce what I say to you. A couple things to keep in mind. The program is designed with the primary objective of achieving mortgage modifications involving principal reduction for approved, eligible, and qualified individuals. Now, I know that's a mouthful, but you have to get it all out because sometimes people just hear mortgage modifications with principal reduction and they think that's for them. But you have to have an approved hardship and be determined qualified for the program, which are the added steps that most miss after they hear principal reduction. So we'll talk about what that means. Well, some of the challenges to principal reduction mortgage modifications lie in, number one, who owns your loan. This last paragraph speaks to the fact that if your loan is government issued or government insured, that's when you hear the Fannie Mae, the Freddie Mac, the FHA, the VA, the USDA. None of those loans are eligible for principal reduction because the contracts that are in place that govern those loans prohibit it. The hardship that's created as a result of that is that we have some eligible qualified individuals where principal reductions really would be a good solution to their situation, but because their loan is government issued or insured, it won't work. And so we try to make that disclaimer right up front, just so they'll get it. Now, the secondary objective of our program is we've rolled out an unemployment mortgage assistance program, and that's to assist those who are currently unemployed and unable to make their mortgage payments. And we truly just assist with the payment. It doesn't modify the loan in terms of reducing the principal balance or even changing the payments, but the ideal is to provide enough assistance over an extended period of time so that hopefully there'll be a change for the positive in their financial situation that will get them back on track. And so we'll talk about that as well. And the other program that we're rolling out, I'll do that. But from this website, you can just click anywhere on this picture. The whole thing is an hyperlink that says click here to see if you may be eligible. And when you click that, it'll take you to the second page, or what we refer to as the landing page of the program. And so this is the landing page. And as you see here, self-assessment, are you eligible? Those are the primary things. Again, just a little background information on the program. Talks about the total amount of assistance available to a qualified household, which is up to $50,000. And we'll talk about how that actually applies. Once a consumer actually takes the self-assessment, you will get a login for the site. So returning users come here and log back into the site. It's a way that we can communicate with consumers as we make notes on the file and talk about the status of the file. They actually get that information all through a secured website that improves the communication. I like to say the major key to any successful relationship is communication. And while most of us understand the value of communication, few of us really do anything to improve the quality of communication between us and others, which is why I said to you earlier, I will check in to see if you get what I say, and I will stay to answer your questions in order to ensure you got what I came to give. But so from here, you'd hit self-assessment, and it will take you to the next page in the program. And the next page in the program really is comprised of some questions. I won't read them all, but I will talk to you about what they say and what their purpose is. They're here to capture information for us regarding the consumer that's applying, but also to screen out consumers that we can determine fairly easily aren't eligible. And I'll give you an example as I kind of read through the questions. The first one asks about having made application for HAMP, which is the Making Home Affordable Mortgage Modification Program. And it's just a yes or no capture question, but we want to know if you've been in communication with your servicer, if they've evaluated you for that program, because if they have and declined you, the very first thing that we want to understand is why did they decline you, because that's what we'd have to address to see if we can assist you. Okay, and then it just goes on, you know, is the property a primary resident in the state of Arizona? We've had some people apply who weren't, you know, trying to touch on that. The loan limit, $723,000. Most loans in the state are less than that, but that's what they call the GSE loan limit. So if you had a mortgage that was greater than that, it wouldn't be an eligible loan. Then you see some other information about the mortgage payment and the household income. I do want to touch on that. We look at household income, so let's just say $2,000, and 31% of that, or $620, would be what we would consider an affordable, sustainable mortgage payment. Long time accepted. FHA, VA, when they were doing lending, used 31% of our gross monthly income. And that's important because a lot of consumers fail to realize when you qualify for a house, they actually use your gross monthly income, meaning before taxes. But then after we own it and we find out we get to pay for it with after-tax money, we feel we really can't afford it. But the issue is if it's still less than 31% of the gross, you wouldn't have what we'd consider a non-sustainable mortgage payment. So very important, 31% of the gross. So when you enter the mortgage payment and enter the household income, that does a calculation behind the scenes to see if it is greater than or less than 31% of the monthly gross income. And then they just answer a few other questions about the property and second mortgages. And we can include a second mortgage. We have a program component to address that. Asked again about notice of trustee sale. The reason is it takes time to get through this process, and if a person has a trustee sale, you know, within 60 days, it's not likely, unless we're in an agreement with their servicer, that we're going to be able to provide assistance that's going to somehow avert that foreclosure. And so again, we screen them out for that. And then it just asks about the hardship, which I kind of summarize with 3 Ds: death, divorce, and other disasters. But the hardship can't be what we refer to as self-inflicted. You couldn't have quit your job. You couldn't have been terminated for your job for cause. You couldn't just, you know, spin yourself into oblivion by cashing out on your property. And I'll touch on that a little bit at the end, because I know we live in a society that has encouraged that somewhat, and yet we can't absolve the consumer of their responsibility to manage their finances. So that's one of the things that we look at as we look at the eligibility of the hardship. And then the servicer drop down, and that just has a list of a lot of servicers. We use the HAMP information to begin with as a template. Most servicers are there, but in the event that yours isn't, you can select other, and then we just add them. But that's just so we can capture the information, track how many consumers we have make application from any given servicer, and what the results of those transactions are with those servicers. Okay, because data is another essential aspect to this. When you hear a lot of anecdotal comments regarding what's occurring, but when you can actually look at the facts or put faces with the pictures, now it makes a major difference. And so this has been extremely helpful to us to capture it. But you would just hit save and continue, and the site would then determine, as it evaluates your answers, if you were eligible for the program. And it'll show you, when you click enter and move to the next page, a recap of your answers to those questions, so that you can double check to make sure they're consistent with your true situation, and explain to you what you would need in order to proceed through the process. If it gives you at the very top, you may qualify for the SaveHomeAZ program. If it says you appear to be ineligible, it will give you the foreclosure help hotline number, which is also on that handout, and it's 877-448-1211. So that'll put you in touch with one of our HUD approved housing counseling agencies that's working with us to support the program, and they begin to talk to you about other potential options. But again, if you talk to them and you say I weren't eligible, they really should ask you what were your answers to the questions, because that helps them to identify more readily what may have been the thing that kept you from being eligible, and what they may need to address in order to explore other options. Okay? So you take from this slide and then you would just go into the program application. As you begin to complete the program application, it's going to ask for all your personal information, you know, number of people in the household, dates of birth, last 4 digits of your social security number, household income, household indebtedness. So you want to be sure to have not just your credit expenses like credit card, auto loans, student loans, government loans, but living expenses, lights, gas, you know, insurance, utilities, and so on and so forth is the information that the system wants to capture, because it's trying to do a holistic analysis of your financial situation, not just a credit analysis of it, okay? And so then you move from here on through the slides. Click that, thank you very much. Now I'll talk to you about the program overviews, because I don't want to walk all the way through a whole application. Really, it's just your personal data. And if you have that information and are fairly comfortable with the computer, probably take you 20 to 30 minutes to get through the online application process, okay? These are the components of the program. The first 3 are in place. The 4th one is just being put into place. But I wanted to present it here just to give you an awareness of what's coming. And we're considering some other things as well, because one thing I've learned long ago, and that is whenever you're faced with a challenge, you have to assess it, make any necessary adjustments, and then seek to overcome it. And you have to repeat that process until you complete that process. And so as we continue to assess it, we're making adjustments to overcome it, and then we are seeking to do just what we sought out to do. The principal reduction mortgage modification, I mentioned it to you. Let me put it in clear layperson terms that I believe. And actually it's for any modification, but primarily for our principal reduction. The consumer that qualifies outside of their hardship must have sufficient income to afford a mortgage that is reflective of the current value of the home. You get that? Sufficient income to support a mortgage that's reflective of the current value of the home. So back to our example, if it was a $300,000 mortgage and the house was $300,000 at one day and now it's only worth $150,000, you have to have sufficient income to afford a mortgage of $150,000 in order for the lender to really consider a modification based on $150,000. Otherwise, if you can only afford $50,000 for an example, they can sell the house and make $100,000 more. So it just doesn't really become a viable option for the lender. And I understand as an individual, you may not like that, but I want to give you the facts so that you can face them and then determine what you do. And that's what the lenders really look at, is can you afford more than we could get if we just took the house? Doesn't matter what type of modification they're doing. If they're extending the term, reducing the rate, forbearing, which is what they call it when they set aside some of that principal balance, or forgiving, which is what we're looking for them to do, is they set aside that principal balance. At the end of the day, you have to be able to afford the current value of the home in order to have a real possibility of a mortgage modification. Make sense? Okay. Second mortgage settlement. Because we live in a marketplace that has a large number of second mortgages as a result of purchasing the homes. And I really want to make this clear, because right now this program does not allow for assistance to any home that's been used to cash out. So if, for example, you've been in your home for 10 years and you bought it for $200,000, but when the values went up to $300,000, you refinanced it and took out $60,000. So now you owe $250,000. Regardless of what that additional money was used for, home improvement, medical expenses, education, college, a wedding, it doesn't matter. It makes the property then ineligible. We are in the process of reevaluating that, and I just want to take this opportunity to share with you why we first made that rule to begin with. We expected to be inundated with opportunities to assist consumers beyond our ability. And so we had to create standards that hopefully would screen out a sufficient amount of consumers and leave us enough to assist, right? Well, when we rolled it out, hoping that we'd make the progress that we wanted, we discovered we can't make the progress that we want because of the GSE loans that aren't allowed to participate that I mentioned to you, and they represent somewhere between 60 and 75% of our marketplace. Because lenders are not as readily willing to participate in principal reduction, so that further reduces the number. And so we are finding it difficult to get enough eligible and qualified consumers whose lenders will work with us for the principal reduction. This is the reason we've been expanding the program to add the unemployment piece, to look at the short sale piece, and we're still looking at making some type of a modification to the cash out piece to give us more flexibility to be able to assist more consumers. But for now, I want to be clear. If the property's been used for cash out, it's an ineligible property. But if the second mortgage was used to buy the home, or used as a refinance of the home, as people sometimes do, you get a loan for $300,000, you refinance it and do $260 on the first and $40 on the second to get rid of the mortgage insurance, or PMI, you may be familiar with, then it would still be eligible. So don't sell yourself short, make sure you understand the process. In some cases, just the second mortgage alone is what creates the hardship. We will look to extinguish those second mortgages either as a part of modifying the first mortgage, whether through HAMP, through a proprietary modification, or through our program modification, and eliminating the second mortgage in that process, or just eliminating the second mortgage by itself if it creates the hardship. And then moving down to the unemployment mortgage assistance, as I said, that was something we added in March of this year. We're getting a lot of traction here because for the household that's eligible and unemployed, we assist them with the payment of their mortgage up to $2,000. So if they have no income beyond unemployment and the mortgage payment is $2,000 or less, the program will actually cover that entire payment for up to a 2-year period of time. If they have some income but not enough, and there's still a person unemployed in the household, then we look at 31% of their income, which is what I explained to you earlier is the affordable sustainable payment. That becomes their contribution, and we make up the difference with this program to cover their mortgage payment for up to a 2-year period of time. We're looking at a transition assistance, which really just gets into the short sale part of it. And as I mentioned to you, under the Making Home Affordable, they have the HAFA program. And so this can work in conjunction with that or totally apart from that, but we're looking to provide $4,500 to the eligible household to assist with the transitioning from home ownership to rental. And so it just kind of eases the burden of any startup costs. And hopefully we'll have this rolled out and available to consumers within the next, I'm going to say 30 to 60 days. It has been approved, but implementation is what takes a little bit of time as well. Okay? So if you would, to the next slide then. The success standards for the program, we're seeking a 90% approval rate for our recommendations of modifications. And this is a challenging and high goal. But we believe if we will evaluate effectively the consumer situation, which is why I was explaining to you earlier how important it is to understand if you can afford the current value of the home. Because we don't propose to the lender anything that we don't see them thinking of as a reasonable offer, right? And so then we think we'll be able to get them to agree with 90% of our decisions. So far, they've agreed with some of our decisions, and we've actually made principal reduction mortgage modifications. Not to the 90% rate, but we understand that you're going to experience your failures a lot faster than you are your successes. And so we have to go through a lot of consumers making application, a lot of us dealing with back and forth with the lenders, a lot of working on the acceptance of the concept of principal reduction mortgage modifications before we really start making progress toward the 90% success rate. The 90% homeownership retention rate, we believe if you modify mortgages based on the market value, that we'll get a 90% retention rate. And so we're measuring how long the consumers maintain ownership of their property beyond our assistance. And because we're real early in the program, it's not capable of really providing a meaningful number there, but we have standards that we're seeking to adhere to and results that we're seeking to achieve, and they're taken into consideration as we evaluate consumers for assistance. And I just want you to understand that, because then you'd say, okay, I understand maybe why I wasn't eligible or why somebody was, and what the overall objective is if I get the assistance. That being said, let me talk to you about the objectives of the program as we lay those out. The first thing is a marketplace mindset adjustment. I mentioned to you earlier, mortgage modifications involving principal reduction is not widely accepted, has historically never been done. Never. Understand that. And that's why when we talk about GSE loans and the adjustments that it would take in order for that to happen, you're talking literally about an act of Congress, most likely. But there are some ways that are being looked at that can address that. Loans are bought and sold in the secondary market. often. And one of the things that we're looking at is working with a partner to buy mortgages so that we can then modify them. Because once you have that change of ownership, you increase the flexibility. And that's where we think we're going to get our biggest successes, because we'll be able to work with that partner directly to modify those loans appropriately for those consumers, which will be far easier than it's been working with the current investors who have those loans. And I'll say this in support of the investors. You know, you make your payment to Wells Fargo or Bank of America or Citi or Chase, but in probably 85 to 90% of the scenarios, that is not the one that owns your loan. They are simply the servicer. And so I want to share this terminology with you to improve your understanding. The servicer collects your payments, distributes your payment on behalf of the lender, or what they call the investor. And that lender and investor is not working with that transaction on a daily basis. They have a pooling and servicing agreement, a contract that says what the servicer can and cannot do, and that's what the servicer adheres to. And in terms of modifying those agreements, extremely difficult. And if those servicers do anything outside of the authority delegated to them inside those agreements, they have major responsibilities. So it is complicated. And it is difficult, and yet at the same time, I say they can improve on the communication of the process, which would at least help with the understanding. But I say that because I really want you to understand that that marketplace mindset adjustment is not just for the servicer or the investor, but it's also for the consumers, because I mentioned earlier, we don't have a marketplace full of people that readily support this ideal because they're saying to themselves, nobody's giving me $50,000. But when houses go to foreclosure, all of us are adversely affected by it, and that's how, when we support the program and ensure that it's properly administered, we too benefit from it. God bless you. Permanent mortgage modifications, that's just a slight variance from the HAMPs, but as I mentioned, they reduce interest rates down to 2%, which you may hear about. They extend mortgage terms out to 40 years, and they forbear or set aside principal balance, which basically ends up with a balloon payment at some point in time. What we seek to accomplish through the mortgage modifications we create through the program is we don't ask the lender to reduce the interest rate beyond what it is. We don't seek to extend the term beyond what remains. We only focus on the principal balance down to the market value of the home. And so if the consumer couldn't afford that, we would say then you're still not eligible. But if you can afford it, now it's reasonable, because we're not asking the lender to take on additional risk, and we're ensuring that they'll get at least as much, if not more, than they would if they just foreclosed on the house. So it's pretty hard to argue with that on the surface, yet it's pretty difficult to make that happen in the real world. Sustainable mortgage modifications. Because our program doesn't reduce the rate or extend the term, there's no change in the future to those payments. Unlike the HAMP, it does fix it for 5 years, but if the rate is below market, then it will graduate. And then if there's a balloon, remember, it comes due at the end of some point in time, and you just don't know what the future holds. I mean, none of us can guarantee that. I think that guy's comment about this past Saturday is proof of that. But we want to at least begin where we know we'll end, okay? And then the mark-to-market transaction, that's what I was talking about when I said bringing the value of the loan down to the value of the home. So you get a mark-to-market. If it's worth $200,000, even though they owe $300,000, we look to bring the loan principal down to $200,000. All of those are major adjustments in the way that our marketplace has worked and does think currently. So with that in mind, we'll talk about some of the challenges as a result of what we're seeking to do. GSE loans at the top of the list because they are the top of the list. Most loans are somehow affiliated with the government. And so either figuring out how we can get loans that they issued or insured sold so that we can have increased flexibility, or how we can get a process in place that allows us the flexibility to change those, is the number one challenge, because we could help more people sooner if we can make an adjustment there. And so we continuously work at that. Commercial lender participation. Bank of America is one of our participating lenders, thank goodness now. National Bank of Arizona is one of our participating lenders, and each of them are working with us to make principal reduction mortgage modifications for eligible qualified consumers. And we have been saying to B of A customers again and again, if you worked with them in the past and you didn't get the results that you desired, don't be reluctant to work with them now, because things have changed. and things continue to change. And so if you get a notice from them, open it up. If they're your servicer, call them, because they are working with us. We can work with you to ensure you get a proper and timely evaluation of your situation. We can't guarantee you'll get the assistance until we know the details, but we can ensure a proper and timely evaluation. Mortgage-backed securities, and that was a part of what you hear about the Wall Street loans and so forth. We're trying to get some of those investors of those loans to provide some expanded flexibility or either clarity to the servicers of those loans that will allow them to make these types of modifications. Managing consumer expectation. I think that's the second greatest objective really that we have, because people hear you have some money, or they hear you have a charge to do something, and they're saying, you're not doing anything for me, what's the deal? And the truth is, I like to say expectation is the foundation of disappointment, and that's why it's very important that we help you understand how to make application, but also how to become qualified. Because a lot of us with proper understanding, we live in what is commonly referred to as the information age, where the library, I think, what better place, because we have access to a large amount of information. The problem is that we equate information with knowledge, and the truth of the matter is they're not synonymous. I like to say knowledge is information understood. When you apply that understanding, it's what we call wisdom, and it creates power. What we seek to do is increase your understanding of the information so that you can properly apply it to your situation and produce power, whether it means transitioning out of the home or getting the modification, but being able to come to terms with your situation based upon your own level of understanding. That's essential. So managing consumer expectations, helping them to understand the program, how it works, how to access it, and how to evaluate their particular set of circumstance. Critical. Communicating consumer selection process. Those who aren't eligible, making sure they understand why not. The program actually has an appeals process, so that if we made a mistake or somehow didn't have sufficient information, we want to allow people an opportunity to help us better understand that so that we can assess, adjust, and overcome. And then the last thing, facilitating the transactions. No matter how many ways you slice this, every transaction is an individual. And while there is a methodology to the process and a plan behind the process, it still takes one at a time in order to get through the process. And it's a lot. It just really is. So I'd ask you to keep that in mind with your servicers as you're talking to them. So you want to track it in mind with the housing counseling agencies when you're talking to them. I mean, every transaction represents a household, and every household is slightly different. And the time is significant. These are our overall projections for the program. We'd like to do a little over 6,000 permanent mortgage modifications, 1,500 second mortgage settlements, and they can be a combination between that too. As I mentioned, a lot of loans have a first-second combination. A little over 1,400 mortgage unemployment assistance programs, and we're thinking slightly under 1,000 transition assistance programs. These funds became available to us, and the program rolled out in October of last year. We're just really starting to make progress because of all of the challenges that stood before us as we got the program in place. We really hope to see these numbers pick up this second half of the year, having the partnership with Bank of America, the partnership with National Bank of Arizona, and more importantly, the partner that's seeking to buy loans and work with us is where we're thinking we're going to get our greatest progress in the program. And so check with me in 90 days, 120 days, and we'll see how we're doing. Okay. Again, I want to thank you for your time to allow me to explain the program to you. I truly encourage you to go to the site and read the information, because it is fairly self-explanatory, but there are some pieces to it that I know you may not comprehend. But if you'll evaluate it first, it improves the foundation for us to explain it to you later when you call. The most simplest aspects of it is looking at your household income, and that is gross, and determining what is 31% of that. And then taking that 31%, and you may not be able to do this without a financial calculator, but the ideal is I take that number and I just say, okay, if they have 25 years left and a 5.5% interest rate, what's the present value of that money? And if the present value of that money, and you got to be sure to pull out your property taxes and homeowners insurance so you get to what they call principal and interest. If the value of that money is, we'll say $150,000, then I look at what's the value of that home. If it's in that range, then you say it's reasonable to think you can get a modification. If it's more, it's not reasonable. If it's less, again, it's reasonable to think you'll get a mortgage modification. That's the basic foundation I try to help every consumer understand, just so they can at least get a better picture of, does it seem really possible or not? And then going from the it's possible to not, I understand is a process, because it involves heart and soul and a lot of physical stuff. And so we don't try to downplay that, but I really do try to upplay the fact that you got to understand the facts first. Thank you again.